Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, I brought on a special guest, Bob Elliott. Bob, the CEO and Chief Investment Officer at Unlimited Funds, a startup ETF company making diversified, low-cost index ETFs available to every investor. Its first product, the HFND ETF, is one of the fastest growing, actively managed independent ETF launches of the last few years. Bob, welcome to the show.
Thanks for having me, Marc.
So in looking at your background, I saw that you spent nearly 15 years working at Bridgewater, which for listeners who may not know, it's the world's largest hedge fund. Can you talk a little bit about your time there and basically touch on how you transitioned from that role to your current role as the CEO of Unlimited Funds?
Yeah, for sure. I mean, when I started at Bridgewater in the early 2000s, it was really a challenger organization in the markets, which is hard to believe now that it's the incumbent, and really premised on this basic idea that you could use systematic rules and decision making to trade macroeconomic environments and markets. And that at the time, macro in the early 2000s was really the realm of the savants, right? The Soroses who would bet on, make large speculative bets in macro markets. And this idea of using systemization, rules-based decision-making in order to understand what was most likely to transpire really was novel. And so, I was part of the small handful of investors that helped build, the decision-making rules as well as, the company at large over the course of that 15 years, going from being the challenger with, a few $1 billion under management to being the incumbent. And I think for me, it was a very formative experience, obviously, where I got a deep understanding of how the hedge fund industry works, how you develop hedge fund strategies in a rigorous and systematic way, and really sort of set the stage to then do what we're doing now at Unlimited, which is to use a combination of our decades of experience creating hedge fund strategies, proprietary hedge fund strategies, with modern machine learning approaches to look over the shoulder of hedge fund managers and see what they're doing in close to real time, and then take that understanding and translate it into positions that back our ETF. Without that experience, having built the strategies inside, one of the most sophisticated institutions in the world, I wouldn't have the understanding and perspective to be able to take that and create the technology that, now makes those sorts of risk-return profiles available out there in the rest of the world with our ETF.
Yeah, and you mentioned the systemized decision-making, and the CEO, or I guess Chief Investment Officer of Bridgewater, was Ray Dalio. He wrote a famous book called Principles. The book had maybe 100, 200 different principles, and it was definitely a lengthy book. But I think that was my favorite one, is how he had, I think it was a 5-step process he had to systematize his decision-making. And you can obviously apply it to investments, but you can also apply it to pretty much anything. And it's, looking at all the options, analyzing the facts, visualizing kind of the pros and cons going forward, and then kind of making your decision off of that. So that was a good book. It was tough in spots to get through it, but definitely interesting book. And I can see a lot of things that he labeled as principles, or he called principles, were definitely applicable to things outside of investments. All right, so now you kind of take some of the things you learned or you worked on there, you bring them over to Unlimited Funds. I guess at what point did you say, okay, we can build something better, or this is what we think is a next step up or a better product to build? And how'd you come to start the ETF from there?
Yeah, I mean, my years in the 2 and 20 industry, both at Bridgewater, I also spent time running a $125 million venture capital fund, which systematically identified opportunities using big data. And I sort of, through those periods, my later years at Bridgewater, as well as my time through the private side of 2 and 20, increasingly recognized that 2 and 20 businesses, hedge funds, private equity, venture capital, those businesses are very good for the managers and not that great for the investors. And the reason why that is because managers are actually quite good at generating differentiated returns, as you'd expect, given the amount of effort and skill that goes into it. But what they're also very good at doing is charging extraordinarily high fees for those differentiated returns. And so what ends up happening is that the investors in those products end up not that much better off than they would be on their own. And so, that got me to thinking hard about whether there was a way to sort of bring the low-cost diversified indexing approach, which obviously has totally changed stock and bond investing for the better for the vast majority of investors. Could we take that idea and bring it to the world of 2 and 20? And so the trouble with that is that most of the solutions that are out there on the market, which are about democratizing access or about getting a diversified portfolio of managers, they have key problems, which is that they almost always have negative selection bias, and that's because the best funds won't take everybody's money. And they also create a fee layer on top of the fees that the managers are already charging. And so our thought was, instead of trying to invest directly in the funds themselves, what if we could use our experience and our understanding of how these managers operate and build a technology that looks at what they're doing in close to real time through the lens of their returns information, compares that to what exposures they plausibly could have on at any point in time, and then basically solves for what portfolio best describes what's driving their recent returns. The idea being basically, instead of star PMs, we're using technology to understand what they're doing, and so we can offer it at a lower fee structure than what a typical 2 and 20 manager offers. And what we can do is we can create a diversified portfolio, which includes the best funds because we can see their returns. And then the last thing is, by putting it in the ETF wrapper, we can make it accessible to everyone. So every investor, even if you've got $20, you can get access to a diversified set of hedge fund-like returns with a single share. And so making that accessible to everyone is a critical part of the whole story. And so that's really what HFND is all about, is that idea of a diversified, low-cost index replication ETF, which is available to everyone.
How are you getting access to seeing what the hedge funds are doing? Because a lot of times what you hear is a hedge fund, it's this black box, they have the secret sauce, no one can go in and see what's going on, and you basically can invest in it, and we'll send you a statement every quarter, and whatever happens behind the scenes, no one knows except us.
Yeah, one of the good things is the vast majority of funds report their returns, some on a daily basis, and then basically all the funds report their returns on a monthly basis. And so that's actually really useful. We don't have to wait quarters to see what's happening. We actually see what performance looks like for these funds in pretty close to real time. I just put out a tweet and a blog post recently which showed what happened in hedge fund performance last week, in fact. And so we actually have a pretty good timely sense of what's going on through looking at their returns. The key that we're bringing to the table is you can't just look at the returns. You have to understand how those funds generate those returns. And that's really where our skill and experience, my partner Bruce and I, us combined, have decades of experience building proprietary strategies at world-class hedge funds. And so we know what goes into those strategies. We know the types of positions and considerations that managers are using at any point in time. And so we use that understanding with that very timely performance information to solve for what portfolio we think best describes the returns that we're seeing, in close to real time.
So you're basically kind of taking the returns, reconstructing the portfolio from the returns.
That's exactly right. And this can sound very black boxy, but if you're in this business, you'll see returns. And if you look at those returns and you compare them to what's happening in markets, you can basically infer what's going on. So I'll give you a perfect example. In the first half of 2022, global macro managers had a lights out period, twice as good as any other 6-month period as they'd had in the last 25 years. Okay, so we know they had good returns in that period. Well, what happened to asset markets in that period? Well, we know bonds sold off. We know that short rates sold off. We know that commodities rose, and we know that stocks declined. Okay, so how could macro managers have generated the sort of returns that we're seeing in the market? Well, they must have had a combination of those positions which ultimately drove those returns. And so that's really what we're doing. We're taking that intuition. Of course, any month you can look at the returns, you can see the asset markets, you can know what sort of positions various fund managers are holding, and you can sort of intuit what's going on. All we're doing is we're bringing a level of sophistication and systemization to that process that goes beyond just sort of our gut intuition to something that is a little more rigorous, leveraging modern computing power and computational strategies.
And you mentioned diversification, and it's a way for investors to get access to diversification, but it seems a little bit counterintuitive to the hedge fund world, because the hedge fund world might say, well, diversification, you're going to get the market return. We're trying for alpha, we're trying to beat the market, and therefore we don't want to diversify. We want to actually find where we can beat the market. Why do you like diversification, or why do you add diversification to the ETF?
Well, diversification is the only free lunch in investing, because if you can put together a set of different returns, some of which perform well at certain periods, some of which perform less well at different periods, and can offset different asset returns, assuming they go up over time, you can create a more consistent return stream. Just think about why so many people hold a combination of stocks and bonds in their portfolio. I mean, in general, maybe not last year as much, but in general, stocks and bonds both go up over time, and they often offset each other during various economic environments. And so it makes sense to put them together because the two together create a more consistent return stream than each one on their own. The interesting thing that you can think about, if you think about hedge fund managers, and what hedge fund managers are doing is they are creating strategies that beat the market. That idea is called alpha, the idea of returns that are in excess or differentiated from the market. That's called alpha. And you can think about alpha in the same way as you think about normal asset returns, which is these various managers and these various fund styles, all of them you would expect to earn alpha, create alpha over time, differentiated performance relative to index investing over time. But at any one point in time, some managers may be doing better, some managers may be doing worse, some fund styles may be doing better or worse, like equity long short did very well for a few years, and global macro didn't do very well, and then in 2022 it flipped, right? But they all perform over time. They're all positively performing. And so what you can do, in the same way you think about balancing stocks and bonds, you can think about balancing hedge fund style strategies like global macro or fixed income ARB or equity long short. And if you package those together, you get a much more consistent return stream than relying on any one manager or any one fund style. What I like to call it diversified alpha, right? In the same way you create a diversified asset portfolio, you can also create a diversified alpha portfolio. And that's much better, much more consistent than any one particular manager who, even great managers are going to underperform close to 50% of the time.
Yeah. How active is the fund? Or is it something you're day trading, or is it every month you look and kind of look back and see what the hedge funds are doing, or is it less frequent than that?
Yeah, if you think about what we're doing, we're trying to understand the wisdom of the crowd, so to speak, because the idea here is to create a portfolio which reflects the positioning of the aggregate hedge fund industry across a bunch of different fund styles. And so when you look at any one of those fund styles, for instance, what you see is that, people's thinking, managers' thinking, certainly in aggregate, evolves over moderately long periods of time. So let's take equity long short managers. Coming out of COVID, they were pretty bullish on tech stocks and bearish on retail. And that, made sense given the macroeconomic environment. And then roll forward 18 months, coming into 2022, they started to ease back their positions on tech stocks as they became more expensive, and the macroeconomic cycle started to get later, and pressures for the Fed to tighten started to emerge. That's a very typical example, which is, it takes 12 to 18 months for this thinking to evolve and the positioning to evolve. And that is essentially what happens with the fund itself, which is it reflects the evolution of this thinking over those typical time frames.
Were you worried at all about, so you have your hedge funds, and hedge funds have to report performance. There's mutual funds, and they do have to report holdings, but ETFs are even more open in terms of their reporting, and you can go into any ETF right now and see what's in there. Were you worried at all about, okay, if I do this, it's easier for someone to copy the strategy? Whereas, because I know there have been I know hedge funds have definitely resisted. I know there are mutual funds that even resist making ETFs because of that. How, I guess, worried or concerned were you about doing it in the ETF wrapper?
Well, the first thing that we started with when considering which wrapper to put this product in and the strategy in was, what's the best product for the investor? And it's unambiguous that ETFs are the best product for the investor. And the reason why that is that they're tax efficient. Well, this isn't tax advice. In general, if you hold an ETF for at least a year, you only pay taxes when you sell the asset, and you typically would pay capital gains except for any dividends along the way. So it's a more tax efficient structure. It's also more liquid, right? ETFs have the ability, you can trade, intraday if you want it. And you can trade it on an exchange, so you don't need to deal with, getting into or out of a mutual fund, and certainly much more efficient than an LP type structure. And the other thing which you highlight is transparency. Now, transparency goes both ways. Part of what we're doing is we're showing everyone what positions we have on. Now, that is somewhat helpful to others, though just direct replicating it is not necessarily that great, because first of all, you don't know where we're going with our positions, so you don't actually understand what the strategies are. And second of all, if you take it outside the ETF wrapper and you say run it in an SMA, you lose a lot of the tax efficiency of it, because the nice thing about the ETF is you can have a multi-asset portfolio that's rebalancing and can wash the capital gains in the structure, so that the investor doesn't see the capital gains and losses. And so you would lose those efficiencies. And then I think on the other side, what's the benefit? There is no ambiguity about what we're doing. You go on unlimitedetfs.com, you can download our holdings, you can look at what we're doing, and you can judge for yourself whether that makes sense, whether you're comfortable with it. You can monitor the strategy if you're an investor to see how it's evolving, which is totally different. The credibility that you get is from that with advisors and investors is just so much better than if you're in a mutual fund structure or an LP structure where it's pretty ambiguous what you're doing, right? How often are advisors, I hold mutual funds or LP positions, I'm sitting there going, what are these people doing? I have no idea. Versus that's the beautiful thing about the ETF structure is what's going on. There's no ambiguity, right? And so even though people might replicate what we're doing in one way, shape, or form, I would much rather have a structure where investors can see what we're doing very clearly with that transparency and judge for themselves whether they think it makes sense, than hide the positions behind, obfuscation that exists in mutual funds or LP structures.
What is the ETF benchmarked against? Like, everyone wants to benchmark against the S&P 500, but is it benchmarked against that? Is it benchmarked against a 60-40? Is there a hedge fund benchmark that it's using, or maybe multiple?
The fund itself, from the perspective, is focused on generating returns, total returns, and so there is no specific index that we're benchmarking against as written in the prospectus. That said, what I can connect to is what we're using in terms of our technology, what we're running our technology against to generate the views that we are. And what we're doing there is we have constructed our own index of the gross of fees returns, meaning the returns before you take out the fees of the hedge fund industry. And that is what we're using technology to understand what the positions are and what's driving the returns. Now, to be clear, the gross of fees returns of the hedge fund industry is not an investable asset. If you can invest in it, if you find the ability to invest in all hedge funds on a gross of fee basis, you should invest in that all day long, right? And so we've set ourselves up for a benchmark that is not an investable benchmark and a very high hurdle rate, right? That gross of fees benchmark, gross of fees hedge fund return benchmark, through time over the last 25 years returns, 100 basis points better than the S&P 500 with half the monthly volatility and a third of the drawdowns. So that is quite a high hurdle. And really what we're trying to do is we're trying to deliver returns that are equivalent to the hedge fund industry. But because we're charging lower fees, right, because we're charging 95 basis point management fee rather than 220, we expect the ETF to outperform reported hedge fund industry returns net of fees. That's what we're trying to do. And so there's a number of different reporters that you can look at on that front. Barclay Hedge or HFRI or Credit Suisse, a number of different. Bloomberg, for those folks who might have a Bloomberg, has an index as well. And so they're all pretty close to the same. There's some nuances that I won't bore people with, but you could look at those indexes and you could basically say, is this product doing better or worse than those reported indexes? To be clear, those are reported net of fees. So our goal is to beat those net of fees reporters.
And you mentioned that the 2 and 20. Can you explain what that fee model is? Because I think a lot of people want to get into hedge funds. They don't realize what they're getting into when it comes into fees.
Yeah. So 2 and 20 is a bit of a shorthand description of the typical fee structure that you see in a number of asset managers, both hedge fund managers as well as private equity and venture capital and others. And what that refers to is typically managers will charge a fixed fee each year of 2% of the assets under management that they're managing. And then they'll charge 20% of the returns of the fund, the positive returns of the fund. And so that's sort of the 2 and 20 idea. As an example, if you just think about that from the perspective of, let's just say, a 10% returning fund before fees, what that means is that those funds would typically take 2% from that 10% right off the top. So you go from 10 to 8. And then they typically take 20% of the returns of that 8. So, you'd lose another 1.6. And so the net of fees returns of that 10% returning vehicle would be something like, 6.4% or something like that. And so if you look at that as an example, if you just think about, these days cash is returning, what's cash returning? 4.5 or 5. If you think about the returns above cash, what you get as an investor is like 150 basis points, 1.5%, and the manager above cash is getting paid, 3.6%, right?
Right, yeah.
That is the problem. I mean, if you were getting 10% returns, that would be pretty good, right? In the scheme of things, particularly, given the volatility and the drawdown profile of those returns. But, if the manager's getting 3.6%, and you're getting 1.4, that highlights that there's a fee problem. The problem is the fees. The problem is not the strategies. The problem is the fees.
Yeah. And I think the other thing, going back to kind of your decision to put this in an ETF wrapper that we maybe talked about a little bit, but it's the liquidity too. I think I see a lot of times where people will invest in a fund or some kind of private equity or hedge fund, and for whatever reason, they don't like it, they need the money, and they don't realize that in that 60-page document that they signed, it says you don't have access to your money, or, you may have access, but you have to give us 6 months notice, or something like that, where the ETF, you don't like it, you can sell it the next day or that day or at any point. So I think that is an important feature of ETFs versus when you talk about some kind of private fund.
Exactly. I like to say that we have to earn our keep every single day, because every single day an investor can look at what we're doing and just sell it. That makes it harder for us and better for the investor. And I think that's a great thing, right? Why shouldn't investors be able to get access to their capital when they want it? And I think that we've talked a lot about HFND and our hedge fund replication, which is our first product. But some of the other things that we're working on are private equity and venture capital replications, where the illiquidity is very extreme. Many investors I talked to today who invested in venture funds over the course of the last couple of years turn to me and say, I know that it's going to be tough sledding for venture funds and private equity over the next couple of years because of the macroeconomic environment and because of the valuations that those investments went into. But I can't do anything about it. So imagine you're holding a fund. Imagine you're holding a venture fund or a private equity fund, and you think that it's going to go down 70%. And there's literally nothing you can do about it because your money is locked up. It's locked up for as much as 10 years. And while it's going down like that, recognize that the manager, regardless of the outcome, is getting paid.
Yeah.
He's getting paid to deliver a poor return, regardless of whether or not it's a good return or a bad return. That the manager gets paid.
He's making money. Yeah.
And that just isn't right.
Yeah. I want to shift a little bit. You produce some great content on your website. 2 articles stood out. The first one is Only Stocks for the Long Run, Why Target Date Funds Suck. Why is that your opinion? And maybe you can summarize that concept to the listeners.
Yeah, a lot of the 401k infrastructure that exists today is dominated by a small handful of players that are basically push investors and plan participants into these target date funds. The trouble with these target date funds is that the way that they're allocated is highly concentrated and incredibly imprudent. And the reason why that is because, frankly, these funds were set up just to basically take 401k capital in and put it into a combination of stocks and bonds. And that was the level of sophistication that was easy for Vanguard and others to run. And they actually charge reasonably high fees in the scheme of things for these products, given what they're offering. And it's a pretty good business for them. The problem is, if you think about how those target date funds are structured, let's say even someone who is, let's say close to retirement, those funds may have 50% of the capital in stocks, right? And the only diversifier that they might have is bonds. And those bonds are short duration, low volatility. So if you look at the returns of those funds, of those target date funds over time, they're structured in a way that, 95% of the return is driven by the returns in the stock market. And the stock market, to be clear, it's very valuable to invest in stocks. And certainly the history in the U.S. is that the stock market has gone up very well and delivered a good real return, which is what you care about as a saver, over the course of the last 120 years. But that doesn't mean it always does. And in fact, if you look over the course of the last 100 years, there's been 3 periods where stocks have had a drawdown of 15 years, of roughly 15 years. Well, if you retire at the beginning of that 15 years and you have to face a stock drawdown over that period, it can meaningfully impact your retirement. And that's what I worry about today is we're late cycle, we're in a tightening dynamic. What happens if stocks go down 20 or 30 or 40%, which is, I'm not calling for that right here, but I'm saying that is a set of risks that as a saver you have to be prepared for. And do you have in your 401k the sort of assets that will do well in those environments so that you're not stuck in such a substantial drawdown and have to either delay or change your retirement? And so what I argue in that piece is to look for other assets that create improved diversification in order to create a more consistent return. And those assets are, for instance, buying longer duration or longer term treasuries, which offset stock performance, looking for real bonds, TIPS, which are actually pretty attractive these days, particularly for late savers, given the fact that they offer 150 basis points of real return, guaranteed. If you hold the bonds to maturity, you get 150 basis points of real return, which if you're a late saver, that is actually pretty darn good, all things considered. And then, of course, other assets that protect you against inflation, like gold and commodities, are also, in prudent sizes in a portfolio, can be beneficial as well.
The other article I found interesting was titled, "Is the U.S. economy in a recession?" So I think recession, I guess before this bank crisis, was probably the number one question that I got was around recessions. So I guess to ask you that question, is the U.S. economy in a recession? But even to expand on it, do you see it going into a recession? And then the third question is, does it matter to the markets?
The U.S. economy is not in a recession. And if you look at, in that piece, what we do is we look at the data, NBER, which is the National Bureau of Economic Research, which is sort of the official agency that calls recessions eventually. We just look at the data that they're looking at when they assess whether an economy is in recession. Now, they do it almost always after the fact. And so what we're doing is we're looking at that data in real time to see whether or not their decision, whether they would decide based upon the information. Taking a step back, if you look at the economy has been quite resilient over the course of the last 18 months of this Fed tightening cycle. If you look at demand, consumption by households, it remains relatively strong, particularly in nominal terms. Employment remains pretty good. Unemployment is at secular lows, at 50-year lows. Payrolls are growing well. Really the only place in the economy that has been softer of late has been a bit of weakening in housing activity and a bit of weaker manufacturing activity. But, those are early in the cycle, typically the first sort of couple of things to slow down in a macroeconomic cycle. And in a typical macroeconomic cycle, it can take a year or two from the point of those parts of the economy slowing down to a point where we start to see a broader slowing of economic activity. And we're basically following that normal path. Tightening in response to a hot economy. It takes a few years for that economy to slow down because the U.S. economy, I think, is best thought of it's like a big tanker ship. It's moving in a direction, and it's hard to slow down a big tanker ship. And the Fed is like throwing anchors overboard, right, hoping to slow it down. But it takes a while for the economy to slow down, and so that's exactly what we're seeing. Is there's still a fair amount of momentum in the economy now. 12 months from now, 18 months, 24 months from now, probably we will see a slowing of economic activity. And I think it's important to recognize in the context of asset markets what's priced in. Whenever you think about assets, you have to think about what's priced into the economy, what's priced into the asset markets versus what's likely to transpire. And there, I think, the biggest concerns that exist are in the equity market, where we've had a sell-off in equities from peak of 15%, let's say, give or take, from the peak level entering 2022. Most of that has been as a function of the rise of bond yields. In many ways, the earnings side of the picture for the stock market hasn't really changed that much. It's actually gone up, not down, over the course of this period. And if you think about that compared to what you see in typical recessions, earnings fall, let's just say 20-25%. Currently, they're not priced to fall at all. And so that's a real gap in terms of how equity markets are priced. And so if we are, I think it's probable that we're on this path to eventually get to a recession. If you look at how stocks are priced, they're not priced that way. And so that really is the concern. For the average investor, this is actually a great opportunity to take a moment, look at your risk, see how much equity risk you have, see whether you can find less equity risk, to look to other assets like long-dated bonds, real bonds, tips could be a good opportunity here, or look at gold and commodities as portfolio diversifiers in the event that inflation is stickier than we expect. This is a great opportunity to do that. You could also look to cash, which, we've talked a lot about cash, but cash is not a bad asset, right? Usually you pay a penalty to hold cash because, the yield is not that great. But cash is yielding you 5% these days, right? And if it's yielding 5% these days, the penalty to holding cash is very low. And so, there's no shame in taking capital out of equities and moving it into cash during a late cycle environment. Now, of course, it's not going to make for a good cocktail party conversation. Oh, I've really got a great T-bill fund for you to look at, but it's prudent money management.
Yeah. No, yeah, it definitely makes sense. Well, we're just about out of time. Bob, thank you for joining us today. You provided some great info on investing, the markets. How best can someone find out more about you and more about the Unlimited Fund?
Anyone can go to unlimitedfunds.com, which is our advisor site and has the blog that you talked about, as well as links to information about our products. And then also, if you're interested in what's going on in the macro economy, I run a pretty active Twitter where you can find me at Bob E Unlimited. We definitely check that out if you want to sort of get the day-to-day view into what's happening.
Perfect. We'll link to all that in the show notes. Thanks again, and thank you everyone for tuning in today.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.